I was just talking to my wife and I said I have to give my last talk to the investor community. I couldn't have picked a better audience. And she said to me, when in doubt, hug it out. So a hug for all of you. But anyway, if we're ready, we start. So good afternoon to the people here, and thanks for having been with us for the last few days in what hopefully was a very exciting, energizing, and enriching few days. No better place to do it than India, in my opinion. And then good afternoon or good morning to the ones joining us here from Mumbai to listen into the webcast. We really appreciate you spending time with us. I have to say, first and foremost, that the 10 years that I've been in the company have been enormously enjoyable, and I consider it a great privilege, actually, to have led this company as a CEO, and but equally feel very proud that we have a wonderful internal candidate, Alan Job, who takes over. It could not be a better retirement present, in my opinion. As you have also seen over the last few days, and deliberately we expose you to our management like we do in many of these events. I hope you also agree with me that we have a very strong management team and board as well, may I add, that is running this company. We're indeed very fortunate. One of the most important objectives of myself, actually, as of day one, has been to ensure that we have, again, an internal pipeline of talent in this company. And this process has definitely led to a great slate of great candidates that could have all taken this wonderful job. And it's a strong sign of the depths of management that we have, in my opinion, and the bench strengths that you will find throughout the company now. Alan undoubtedly will do a great job and lift it to the next level. I have no question about that. It's any of these changes are always tremendously positive for a company. It brings in a bit of fresh air, and Alan comes with obviously enormous values, tremendous curiosity in this fast-changing world, very important, and then equally importantly, the courage that you need to make some of the tougher decisions that he undoubtedly will get in front of him in this fast-changing environment that we have and very competitive industry that we are in. So I have no doubts that you will be very pleased to see from a very strong base where this company goes next, and I'll be equally curiously following it from the position that I find myself in. Let me start very briefly by framing some of the things what we were trying to do and where we are, and then moving into some of the opportunities that I think that we still have in the different areas as a company. The latter thing is far more important, so I don't want to dwell on 10 years, and I'm not so nostalgic. This industry is tough enough that we need to continue to keep looking forward and driving it to the higher level. So with a certain degree of modesty, I might report on what we have tried to do, but certain degree of anxiety, I want to tell you what I think some of these challenges are that we should be doing as we move forward. So the first thing that we firmly believe once more is that the success of this company is based on a long-term multi-stakeholder model. We firmly believe that if we take all stakeholders into account and get the space to do this over a longer-term period of time, then that we can actually maximize the return for all stakeholders. We also believe that the return for all stakeholders means that we first and foremost focus on the people that we serve and the people that make this institution work. And by doing that very well and by doing that diligently and as smartly as we can, ultimately the shareholders will benefit. So we run this company not for the shareholders. We run this company with the shareholders maximizing the return as a result of what we do by focusing on the other stakeholders. I still believe that is your best guarantee, not only to have a long-term return from any company that you would invest in, but also to guarantee that the people you invest for have a world that they can live in, as well as their children and future generations. So what we focused on is very simple. In the last 10 years or more, if you want to, it's very clear that we live in an increasing world of uncertainty. I've always said that this volatility or change that you see is only going to increase. Even today, some people would argue that change has never been so slow. It's already difficult that it is for many, many companies. In fact, Recently, I was looking at some of the numbers when I talked to the Change Leaders Conference that we just finished a few weeks ago. And there was a statistic I picked up from McKinsey talking about the Fortune 500 companies. And if you look at the last 40 years or so, of the Fortune 500 companies, only about 60 are still around now versus the ones that were around 40 to 50 years ago. So that's only 12% of the companies. The rate with which companies disappear is faster than ever. The average lifetime of which companies exist in today's world is shorter than ever. And obviously, most people struggle with that. The average tenure of a CEO of a publicly traded company has now dropped to 4.5 years. The average length of a publicly traded company was 67 years when I was born, believe it or not. Some people would say, I would say it's now about 17 years, but I was already reading that it's dropping to 14 years. Just to stay alive is already a trick in this world that we live in. What we've been trying to do is to recognize this uncertain world and these volatilities, and have tried to give you a little bit of stability, have give you a little bit of peace of mind. I firmly believe that it's not about hitting the ball out of the ballpark every year or dancing to the tunes of anybody who wants a quick return. That's actually the easiest thing to do. And you see many companies that have tried to do that and try to run their cylinders, try to run their cars on 6 cylinders, eventually ran into the ground. And when they did, it was fairly ugly, also for the longer-term shareholders. What we are trying to do is to run this company year in, year out, consistently. And I hope that in this more volatile world, that consistency will increasingly be rewarded. 10 years of top and bottom line growth are very few companies, even within the surviving groups, who are actually able to do that. I see no reason why this company could not continue to do this. It also means not bothering you. Not bothering you is the effects of geopolitical issues, not bothering you is the effects of climate change, not bothering you is the effects of natural disasters or any other things that might come in that we are dealing with now nearly on a monthly basis. But simply being reliable and doing the job for which we get paid to do. We've moved this company from a cell-based approach to a broad global strategic category approach. We've moved this company from a country dominance to a fairly well-balanced country and category focus. We've moved this company from an internal culture to an increasingly external culture. From being an employer to being an employer of choice. From being short-term to definitely having a longer-term approach. As was mentioned yesterday, from fearing competition, which I believe was often driven by the fear of our own failures, to actually being in charge of our own destiny. From being sometimes too slow and bureaucratic to being increasingly leaner and more agile. From managing or disposing brands to actually dynamically creating the portfolio of the future and driving our innovation levels to levels that we've never seen before. In short, we've just simply focused on putting all the pillars in place that ensure this long-term multi-stakeholder success that I'm talking about, including the many decisions over these 10 years that might not have been in the interest of our shorter-term results. Our pension plans are now balanced, probably one of the few companies in the world of this size. We've moved it to direct contribution instead of direct benefit. Many companies will have serious problems in 15, 20 years from now that many in the financial community, unfortunately, are still not factoring in. But a clear example of always trying to do the right things for the longer term. However, it's also very clear to me that whatever we've done and put these pillars in, which I'm glad to hand over, that is in a fast-moving consumer goods industry is absolutely no guarantee to success. We have to maintain this mentality of good enough never is in anything we do. We have to maintain this mentality to some extent of being a little bit paranoid in a positive sense if you want to survive in this industry. And that is obviously what we are trying to do and what we're trying to convey to you in these last 2 days as well. But I do say, without too much arrogance, hopefully, that we feel confident. That's probably the right word. That we feel confident that we're actually better prepared than ever to face the next decade. And I hope that confidence is shared with you, having here been with us and sharing some of these stories a little bit more in detail over the last 2 days. Our strengths, obviously, in the emerging markets is one of our competitive advantages that is next to none. There's no coincidence that we are here in India right now to celebrate this wonderful investor meeting and get together. It's also no coincidence that we are celebrating that nearly at the same time as we are acquiring one of the stronger and most beautiful equities again in India with the Horlicks brand. But the strengths of India and what you've seen this afternoon or this morning with Bangladesh and Pakistan, two of our amazing subsidiaries, by the way, is basically what Unilever is about and what the future of Unilever is about. Look at this chart that Sanjeev showed me yesterday when I was talking to him, and he would be too modest to put it up, and he's too embarrassed of me talking about it. But this was HUL from 2000 to 2012. It saw the share price actually increase on average about 8% a year, and the market cap increased 2.5 times. About $10 billion of value was created. And we were happy with that. HUL was our best performing subsidiary. Yet the reality was we were performing well below the sector. Then you look at the last 10 years. We really started to outperform. The share price increased 26% per annum, and the market cap more than tripled to 55 billion. In fact, our business tripled over that period nearly. 2 times more created than we had created since 1888 being here. That's the strength of a company. And some of you might say, that's the distribution system. Well, I have good news and bad news for you. It's partly the distribution system, but if that's where your thinking stops, you've missed the point of the last 2 days. It's one of the best organizations in the world. In fact, it was called the 3rd best organization globally for developing leaders. And boy, do we see that. It was actually called out as the 8th most innovative company globally, with all the others before them being tech companies, which you would expect nowadays to be on the list, as that's in vogue. This is an institution where the depth of the sales results or the distribution is a result, not by itself, this competitive advantage. This is an organization able to reinvent itself all the time and set the standards of what it means to run responsible business in countries like India. So, ladies and gentlemen, it's a wonderful example of how well we are placed to face this future. You've also heard yesterday from the divisions and their strategies. You've heard from the CCBTs, increasingly the core drivers of our individual businesses, and you saw some of the wonderful country heads that we have. And each of them consistently was talking about the purpose-led and future-fit business model that increasingly is being leveraged under a structure that balances the pressures of being global and being local at the same time. They've talked about how we are transforming parts of the organization to embrace, actually, these enormous opportunities and challenges that we have. Digital being the most important one right now as the topic of the day that you're all interested in, and what it takes to fast implement and become a digitally ready organization, what it takes to fast reskill our own people to bring in talents and retool the systems that support our growth. Now, I'm glad that we've taken the steps that we did. We developed, without any doubt, a more energizing long-term multi-stakeholder vision for this company that is captured very well in the Unilever Sustainable Living Plan, resulting indeed in businesses that are truly purpose-led. And I hope that by now we have shown you and many more companies that are starting to follow us that this drives performance, that this gives competitive edge, that this is one of the best guarantees you can have for the long-term success of this company. We've also brought the center of gravity back to our brands and categories. That's absolutely important. It's the brands and categories and our innovation capabilities that drive the long-term growth of this institution. But at the same time, we have retained our focus on the markets. We've done all that by structuring in 3 divisions, which allows us actually to leverage the size and scale of this enormous company, but also to have much sharper and more focused strategies, streamlined portfolios, and leading brands that allow us now, with accelerated innovation, to grow ahead of the markets. We continuously work our organizational structure. That will never finish. That should actually be an ongoing project anyway. At least that's what we make clear to the people in this organization. But it is without any doubt more agile and leaner. And with the C4G organization, which still has a lot of momentum and opportunities to be embedded in the organization, we're just barely scratching the surface of that. I think we're well placed with our organizational model, especially at a time when we see many of our global competitors struggling with finding that right balance with how you run a global and local organization in these volatile times. It's also underpinned by ruthless focus on people, values, and capabilities. Lena talked about that. It's probably where we put most of our investment, often most difficult to describe. It's actually said that unlike about 50 years ago when 75% of a company's value was on the balance sheet and you could read it, now 15 to 20% of the company's value is on the balance sheet. And you increasingly struggle to value companies like ours. But culture and people is probably one of the biggest drivers of the longer term success. I hope you got a little bit of a feel for that from the presentations that Lena shared with you. And all of this has resulted in fairly decent results. I'm still embarrassed to tell it to my 90-year-old mother and explain to her that we could do all these things, satisfy all these stakeholders, and at the same time give our shareholders a 290% return when the cost of money was zero in a 10-year period of time. She didn't get that return on her pension. Most people that we serve haven't seen that improvement. But we did. We gave you a 290% return, and that put us in the top tercile of the peer groups that we compare ourselves with, driven obviously by consistent growth above market growth. It also shows that it is a better model to run your business on growth in consumer goods than just ruthlessly focused on cost cutting and shareholders only, which, by the way, is a very easy thing to do. I wouldn't have done that job, by the way, because I would have found it boring. It's not why you hire CEOs and pay them the way you pay them. You pay them to do long-term value creation. And by the way, every once-off benefit that you get in cost cutting is totally different than the long-term benefits you get from investing behind your brands, people, or market development. Those are the investments that ensure the long-term cash flow that you should be interested in. And I think that's increasingly playing out if you look at us and some of the others in the marketplace that pursue a different strategy. The pace of change undoubtedly is going to continue. We see the needs for stakeholders that we are serving changing at a faster pace than ever before. There's fragmentation of consumer and channel preferences. We have the on-demand economy that creates an enormous opportunity, but at the same time an enormous fragmentation that we all struggle with. New business models are emerging. Competition is coming out from corners that we never saw before. In fact, the barriers of entry that we were used to have all been scattered in the last few years, and new barriers need to be created. There's no question that value is migrating to data, and data is exploding. More data is being created in the past 2 years than actually in the entire previous history of the human race, a mind-boggling fact. But in fact, 90% of the data that we have in the world today was generated in the last 2 years alone. And again, that growth is accelerating with the Internet of Things and opening up new opportunities, and for the ones that don't embrace it, enormous threats. I feel happy about that because we're a consumer goods company. We ought to be, and we are passionate about serving these consumers. But we never really knew how to do this. In fact, we didn't even know their name. Now, for the first time in the history of mankind, we can serve them to their needs, not what we thought their needs would be. We can talk to them with their name. They're people. They're people like us that have families, that have needs. And for the first time, the 2.5 billion consumers that we serve every day, with the vision that Stan laid down to already have 1 billion first-party data and do this precision marketing, we can talk to them like human beings. For a consumer goods company, that should be the most exciting thing that you can think about. Trust in companies is low. Trust in any institution is low, and rightfully so. Trust is hard to build. Some people say it comes on foot and it leaves on horseback. We're very blessed by being seen as one of the most trusted companies in this world. measured by GlobeScan now for 8 years in a row, for example. I worry about that. I worry about being so far out from the rest of the world, but I also worry about anything that we could do that could scatter that trust, because ultimately that trust is our biggest competitive advantage. It's also the trust that provides these intangible values that you are looking for. But it requires companies to play a different role, increasingly so, if they want to maintain that trust. It requires companies to be far more open. One of the reasons we put 50 targets out there was the Unilever Sustainable Living Plan. It also requires companies to not be less bad or be in the CSR space, but to move to the RSC space, responsible social corporations, where you actively drive the world to a better state of being. Not less bad, but actually addressing and correcting some of these issues that are wrong. You take climate change, for example. It's a very pertinent issue. Our businesses wouldn't be around long term if we don't take responsibility for them. The costs that society is incurring today for climate change alone are over $5.3 trillion. Any company that wouldn't think about that would be out of their minds. It's probably the biggest intergenerational crime that we're committing in the history of mankind. And yet we have the alternatives. Unilever rapidly moved to greening its value chain. We have lower energy right now. I just signed in Russia a few weeks ago 42 megawatts of energy from the windmills at the same cost as the fossil fuel in a country that has heavily fossil fuel subsidized prices. We are immune to carbon pricing that is rapidly coming into this world because we don't have the carbon emissions. And yes, we have a far more responsible model for increasingly a broader group of consumers that not only care about what they're buying, but what the brands and the companies stand for that they're buying from. So I believe in all these things we're on the right trajectory, but change around us means that we need to go further and we need to go faster, and that we need to keep setting the pace. It is indeed my famous sentence that it's better to make the dust than eat the dust. Nothing more pertinent for saying that than in today's world. So let's focus on a few areas now where we have built this very strong foundation I talk about, but where I also see new ways opening up to make us even better and to make us even go faster. Let's start with this famous unrivaled footprint and the strong core. We've made major shifts over the last 10 years. There's no question about it. Probably bigger shifts than many of these, or most, if not all, of the consumer goods companies that you're following. Nearly 60% of our business is now in emerging markets. That was about 45% 10 years ago. Despite the enormous currency headwinds that we've had, which I've never seen consistently now for these 10 years, as the world tries to come to grips with the effects of this quantitative easing and getting out of the financial crisis that we've had. And actually, despite having had a very aggressive M&A strategy that was heavily skewed towards the developed markets. So 2 headwinds, and despite that, being at 60%. Under any normal circumstances, we would have been around at 70%, which is the 75% I was talking about 10 years ago. We've also changed, actually, the makeup of our categories. We were 40% in beauty and personal care as of the end of this year, more or less, and that's up from 28% about 10 years ago. In fact, when we talked about doubling the business, which was a mindset issue of bringing growth back, in personal care, we've actually nearly achieved that. Our business grew from 12 billion euros to 22 billion euros, an increase that's nearly the size of a company like Estée Lauder and many others. Our home care and personal care business now combined are nearly 2/3 of the total business. It required us to bring in the new skills and capabilities to be able to compete in this area. But equally, our food business, in a very tough environment, has streamlined its portfolio to one of the strongest portfolios I believe there is in food, explaining perhaps why we are one of the few food companies that is growing. And not only that, we've done that at the same time as moving our footprint from 75% developed markets and 25% developing markets only 10 years ago to a more balanced 50-50, en route, if you want to, or towards the direction of the rest of the business and getting to the 75-25 footprint that reflects more or less where the population is longer term. 85% of our business now is in leading positions, either number 1 or number 2. And still in this market, the core, the key brands on the core are the brands that are performing best. It's not that you need small brands to perform, it's that you need big core brands that stay relevant, and then you're doing perfectly well. 13 of our brands, we have 13 of our brands in the Kantar top 50 brand ranking, more than any company. There's nothing to complain here. On top of that, we have more brands that are fast growing in penetration than any of these other companies. Our brands are stronger than ever. And that is partly because you've allowed us to invest in that. And we've radically improved our innovation capabilities with reasonably good results. We have significantly more innovations, 28 new brands launched in the last 18 months alone, versus, as Graham pointed out, only 3 in the previous 10 years. Obviously, it took time, but you see it bearing fruits right now. And also, we're bringing these innovations faster to the market at half the speed and rolling them out significantly faster across the world. Things like Hijab Fresh, or Red Red, or Love, Beauty and Planet, or Day 2, or Ayush, or many of the other examples you've heard. Our step up in innovation has helped us differentiate also our portfolio, better catering to these fragmented shoppers, better catering to the fragmented channels increasingly, the health and beauty channel, with products specifically like Love, Beauty and Planet, or some of the other ones. Our models are becoming more flexible to these different channels. Very important, the channel design. The out-of-home channel is now a serious channel. The food service is now a serious channel. Unilever International has set new standards for channels that, frankly, we weren't covering. The discounted, the beauty care channels are becoming major growth channels. And then, obviously, behind these core businesses, you've seen the first embryos of what I call building competitive digital capabilities, things like Livewire and other things that you've seen here. And yes, it's paying out. Our e-commerce business, growing rapidly. In fact, it's growing 4 times faster than the way we read the overall e-commerce market, is now growing to about 2 billion, and very soon, in our estimations, it will hit the 5 billion mark. We've done all this by creating the organizational model to build speed and consumer intimacy. We've rolled in the R&D and into the category groups, which is very important, into the divisions. We've better integrated product supply, and we're all aligned now. Instead of having functional objectives, we have overall corporate objectives. And C4G, obviously, has been a blessing in the sky, bringing us closer to the consumer, making us more entrepreneurial, and was unlocking this key that we were missing a few years ago in terms of agility and response rate. But it's clear that others aren't standing still. It's also clear that we continue to have plenty of opportunities in this industry. That's why I like it myself. We continue on focus on these opportunities. We will continue to do well, as I said before. The first one is a very simple one, but it's the most important one. It's just discipline in all we do. The day I came here, I reminded people that execution is strategy. We try to stay in the clouds and feel very good about that, and look very intelligent if in every sentence we speak we use the word strategy. But at the end of the day, I've never met a consumer in my hundreds or thousands of home visits that buy our brands because they like our strategy. They like our brands because of our ruthless execution, of finding the right brands at the right place, at the right time, in the right store, at the right price, with the right quality. When they had a little request and called us, they got the right customer service. When they were worried about their packaging, they found the right way of how we were taking care of the environmental impacts. We simply are in the business of being better every day a little bit more. Execution drives this business. That's why I like it. That's why I'm happy that I'm not too intelligent. Because too intelligent in this business probably risks on driving too quickly to the strategy away from what we need to do to survive every day. But there's an opportunity in discipline, an opportunity in our category, in our company, that might be as much as 1% of our growth rates, by fixing the customer service issues still, by not having the quality issues, by ensuring that we quickly react and keep our brands on the right strategies where we have them. And yes, plenty of opportunities every day still. Technology allows us also increasingly to set things higher. You've seen it with Leverage and Livewire. We see it on the demand forecasting that we can now do much better with computers than trying to do it manually. Our customer service levels should go up. You see it on the efficiencies and the response rates that we can do with robotic automation systems in our factories. These are all opportunities that we need to embrace and drive with a speed that is higher than we've done before. Our channel shifts I talked about are tremendous opportunities. We need to become much better at the early stages already to designing our products for the channels in which we are going to sell them. Frankly, we were a little bit late to design our products and our product ranges for the e-commerce channels versus our competitive set. Fortunately, we woke up in time and rapidly adjusted, but there's much more opportunity there. How do we properly design for the health and beauty channel? Or how do we leverage the increasing number of own stores that we have? We're becoming one of the bigger retailers. How do we design for e-commerce? We can also do better in the way we reach consumers. And there I don't need to spend too much time, but Stan has explained to you how we're moving from the 200 million consumers that we have currently on record to over 1 billion consumers. We were talking over lunch. The data privacy is going to be a big issue. Countries will not let other countries dictate what privacy is going to be. Standards will start to differentiate, probably between the 4 blocks that our wonderful speaker yesterday talked about. Increasingly, the privacy will be decided by consumers, just like is happening in India now, as we heard yesterday. Companies with this high level of trust will do well. Some companies that might now have the data but operate with a low level of trust, I have my doubts. So we need to further develop these digital capabilities, think differently about data-driven businesses, what that truly means, and have it come in from outside in, where consumers self-select. If there's any indication of where we are today, consumers will select us above some of the other companies that currently seem to master the data. So becoming a truly digital company is absolutely key. Thinking about your data, absolutely key as we drive the core of our businesses. Then next to the core, we've talked many times over the last 2 days about portfolio transformation. We've shaped our portfolio to be more in the faster growing channels or in the segments or in the growth markets. It's for that reason that we've done the 50 acquisitions. Perhaps a little bit post-rationalizing, but it's turned out to be a good idea to make these 50 acquisitions of these upcoming companies. We could have never created those ourselves. The cost would have been too high. The probability of success would have been too low. Obviously, not all work out, but I'm actually surprised at the level of success that we're having. I'm even more surprised that most of these businesses are founder-led businesses, and they're staying with us with the same enthusiasm. We found the right way to integrate these businesses, at the same time leaving the level of independence that they need to be nurturing and growing their own successes. And the interesting thing is, despite having done these 50 acquisitions, the return on invested capital in this company has stayed over the last 5 years at around 19% on average. The money we've spent on M&A alone, including Horlicks right now, is probably around 23, 24 billion. We've added our share buybacks to that and get close to 30 billion. That's a quite sizable investment. You let us do that. We don't want to disappoint you on that. GSK is obviously the cherry on the pie for this. But there is an enormous opportunity, I think, to leverage these brands that we bought better. We now need to think on how do we make it a success. What we've done in the last 10 years is the easier part. What we should be judged on over the coming 10 years is how we leverage those in the major growth pillars of the future. We've also launched in about 200 white spaces, things like Clear in China, Omo in the Gulf, Magnum in the US, Baby Dove in now over 30 markets. Not all of them have worked, but they have done a lot of things for us. They built our business, they gave us the confidence back, and they have shown us that we can win everywhere with our global strategies and not in select markets whilst we were abdicating our responsibility in others. We are here for all consumers in this world, and we're showing that we can do that successfully. It also required a discipline in disposal. In a very steady way, we've disposed of about 50 of our brands as well over the last 10 years. The biggest ones obviously being spreads recently, but we've done that steady pace all along. The Wishbones, the Skippies, the Ragoos, and many of the other ones. But again, we have plenty of opportunities still to roll out our businesses in new geographies where we probably only cover 60% of our potential, and to accelerate our acquisitions that we've made in terms of the global rollout. Our prestige business needs to move to 1 billion. It was a very good move to have about 500 million. It's a very fast-growing business, well over double-digit, in line with some of the best-performing competitors that are in that segment. But you would do even better if that was $1 billion versus $500 million. I also think that that's what we deserve for a company our size, to truly have the impact that we are looking for to strengthen our overall beauty and personal care business. We need to be much faster in driving to naturals and picking up on trends. We now understand these trends better. But we need to be a little bit more courageous to pursue these things with determination. And as I mentioned before, we need to accelerate our presence in some of these growing channels, e-commerce being one of the most important ones. Next to the core and next to the portfolio, it's also about fuel for growth. This environment that we live in right now is far more punishing for organizations that have costs in their systems that consumers are not willing to pay for. You're sometimes worried if we have the balance right between the top line and the bottom line. And you're fine to worry because and it's right to do that because it challenges us. But I've believed, and I continue to believe, that there are enormous costs still that we incur in the system that the consumer isn't interested in. Costs that we can take out without incurring any lack of competitiveness on any of our brands. We've been reasonably good doing that, and we've been reasonably good in growing in increasing our top line growth and margins at the same time. But I believe there's plenty more to go after. We have reshaped our cost and asset base. We have genuinely increased our competitiveness at the same time as we did that. And we have created the fuel for growth behind wonderful programs. The net revenue management program, the zero-based budgeting, the 5S programs. In fact, we're running ahead of the cost savings targets that we've set ourselves. By any benchmarking of the speed of implementation, if you talk to the Accentures of this world and others, they've never seen companies getting so quickly to the savings. Sure, it's a testimony to the wonderful work that our people are doing. But it also is an indication of the enormous opportunities that are still in this company. It has a benefit in many respects. It makes us leaner. It saves the raw materials that this world cannot afford to waste. It makes us more cost efficient in the process of doing that. It has helped us finance the bigger launches I talked about, the new brand introductions, the acquisitions like the Alberto Culvers and the Horlicks. But the opportunities are equally big today as they were 10 years ago, partly driven by new technology that allows us to think about things totally differently and better, especially in the area of product supply, for example, where our go-to-market capabilities, our asset-light strategies are opening up completely different ways of running this business than we were thinking about 10 years ago. In our organizational structures, we're scratching the surface. We need to embed what we're doing right now, but there are many more opportunities to flatten our layers or to adapting our business models using still a fairly generous restructuring pot that is there. On our visits to the West Coast, when we visited all these wonderful technology companies, we looked at Adobe's way of empowering their management and what it meant to really change your performance management systems. We went to Salesforce and talked to Mark Benioff about what it means to really set transparent, radically transparent goals across the organization. And anytime we look at that, we see opportunities for our company to be leaner and more efficient. The US has put in some AI technology on the S&OP processes. They've cut down the meetings, the number of meetings and the time of their meetings by over 40%. Think about that trapped energy that you can get cut out. The Indians that have used predictive analysis with things like LiveWire, which they have pioneered. I had a meeting with them yesterday to take me through that. The amount of capacity that has freed up in the space of our leaders to really do what the value-added activities are that they should be doing. The installation of the U studios or the PDCs and many of the other things that we have in there to be more agile and efficient in our advertising and media spent in reaching these consumers, often at cost 20-30% lower and 30-50% more effective. Enormous opportunities to still drive costs out of this system. More needed now than ever with these pressures that we are getting. Pressures where pricing might not be as permissive as it was in the past, but pressures where costs keep being very volatile, and at times, especially now, in the wrong direction. The fourth area I briefly wanted to touch on is people and culture, probably one of the most important areas, probably one of the least understood areas. But we are in the business of attracting and developing leaders. If we can attract and develop the best leaders, then these leaders can take care of all the challenges that come along. We're not in the business of solving these challenges. Attracting the best and brightest people will give you the best guarantee to deal with whatever challenges come to you in the future, many of them currently unforeseen. More than 9 out of 10 people are expressing a pride in working for Unilever. I would challenge you to show me any company anywhere with a score higher than that. We have an engagement score of 75%, which is among the best in our industry, firmly in the top tercile. Purpose clearly plays a major part in that, and certainly demonstrating what we continue to mention, that people with purpose thrive. We are now the #1 employer in the majority of the markets that we measure. And we are one of the most looked up companies in LinkedIn, with over 2 million people applying to us every year to join this wonderful institution. More importantly, we've created a culture of learning and, may I say, unlearning. We've rolled out Degreed, an online learning platform that gives over 2 million pieces of learning now, 140,000 alone actually specifically selected for Unilever. On Degreed, we have now 50,000 active users, people using it all the time. And we can measure the usage, the skills, the career developments. It starts to pay out. It helps people learn smarter by taking tailored learning recommendations based on their own interest or their learning needs. And as a result, it's artificial intelligence applied to human development. Our Connected for Growth program, with our 239 CCBTs, wonderful entrepreneurial people now, and our 50 brand communities, it's making us more agile and responsive. Greater empowerment, still a little bit more to do, but faster decision making as a result. 74% of the CCBTs, after 1 year of implementation, feel more empowered. And the majority plays back that the speed to market is improving and our competitiveness to compete is next to none. You've heard Lina describe that 80% of our employees believe that their personal growth in digital is now necessary to stay relevant. So one of the opportunities that we have is that we really accelerate the implementation of the learning tools to become digitally native. One of the main concerns I have is that the digital developments and the needs are going faster than the ability that we have to educate our own people. Sure, we need to bring in a lot of people from the outside, but wouldn't it be nice if we can actually have an organization that also, for a great part, can deal with that themselves? So this learning, that the hunger for learning, and especially driving this digital, is a very important part. We also have to continue to become a more inclusive culture. We're fortunate enough to have 50% of our board gender diverse, 48% of our company gender diverse. Our office environment is probably more like 60%. But diversity goes beyond that. I'm very pleased to see, as I leave, that the company has made a commitment to hire 8,000 people with disabilities. There are 1.3 billion people in this world with what you might call disabilities. I call them different abilities, diffabilities. Yet they're hardly represented in the workforce. Wouldn't it be good if we could be the company by excellence that mirrors inside of the company the population of people that we serve outside of the company? Wouldn't that be wonderful, and what that does to the long-term results of this company? That we can treat people with the same respect and dignity as we expect ourselves all to be treated. Think about the engagement scores I just mentioned to you and see what that will be 10 years from now if we succeed in these objectives. So digital capabilities, becoming more inclusive, driving further our agility are some of these areas that we want to drive under people and culture. And last but not least, let me end on purpose. Central to what we do is purpose. I hope you've got that from the last 2 days, but I actually hope you got that from the last 10 years. And we need your help there, because you're as much part of that, not only into believing it, but actively participating in it and acting on it with your own investment decisions, with your own behavior. First and foremost, we're not investors or sell-side analysts or CEOs. We are citizens of this world planet. It is very clear, and someone wise said it once, that the purpose of life is to give purpose to lives so that society thrives and the world survives. That's the essence of what we are trying to do with the Unilever Sustainable Living Plan. The need for purpose is stronger than ever for people who want to work for companies, stronger than ever in millennials who want to make a difference, but stronger than ever for any company who wants to be around long term and wants to leverage or increase this enormous factor which is called trust, which ultimately is the basis of prosperity for everybody. It's a collective responsibility we have to transform companies in becoming more purpose-driven companies. And the evidence to do that, being successful, and the best way of running our businesses is increasingly becoming clear. In fact, the evidence, in my opinion, is already overwhelming for a simple reason, that not having addressed many of these issues out there and abdicated that to what I would call the tragedies of the common has given us a system right now that the cost of not acting is going to be higher than the cost of acting. Unilever, running a purposeful-driven model with an agenda basically mirroring the Sustainable Development Agenda, has a 19% return on invested capital. I would argue that we are at a point in humanity that that is probably the most profitable agenda that you have in front of you. But it needs a little bit of a longer-term focus. McKinsey just came out with research that showed that companies with a longer-term focus actually deliver a 47% higher revenue growth and a 36% higher earnings growth over time. Not surprising, because these companies will do the right things to be around for the longer term. Short-termism, quite simply, is not compatible with the socially responsible model. Short-termism is not compatible with certainly the Unilever operating model, nor is it competitive and comparable or desirable with a purpose-driven consumer that we have. So long-term value creation, purpose-driven, is the only model, I think, that will give you that long-term prosperity that you're also looking for. And that is a big challenge, because you have to remodel many of these businesses. You have to take risk. You have to be a little bit of courage. You have to deal with the cynics or the critics along the way. You have to deal with the people that have a vested interest in maintaining the status quo. Change is never easy. But for the ones that go on that path, it's tremendously rewarding. With the USLP, we've created a new business model, I think, that increasingly we see other people's follow. We see it reducing our risk, avoiding deforestation in your value chain, sticking to human rights and not having slave labor or child labor, moving to green energy, reducing your water footprint or plastic footprint, or driving sustainable sourcing in its broadest sense, all make our business model more robust. It's also keeping well ahead of changing trends and legislation. Many of the governments, many of the citizens are getting fed up. They'll legislate it away at great costs. It's better to take your own initiative and not have to deal with those. Without any doubt, it drives corporate reputation. Right now, I would say it's the driver of corporate reputation. I talked about GlobeScan, but for that same reason, we continue to be #1 in the Dow Jones Sustainability Index, or in many other ones that I actually care about equally, like the Human Rights Watch. It's interesting to see that these monoptically shareholder, short-term focused cost-cutting companies are often on the bottom of this list. I'd strongly encourage you to follow my tweets if you don't believe me. It also improves the growth of the companies. It is actually a growth driver. Because consumers are shifting, it requires you to be more relevant and closer to consumers. The market for purpose-driven products is one of the fastest growing markets that we see in consumer goods. And it drives innovation. In fact, our purpose-driven brands grow 50% faster in our scale of height than others. It's a 2.5 trillion market for us already in which we're operating. In this generation, in the next 20 years, it's about 30 trillion of wealth transfer from our generation to our children. Believe me, they're more purpose-driven. Believe me, they're going to be more careful of where they put their money. I don't have to talk to you about reducing costs. Reducing per ton production of water or of energy, in our case by 45%, reducing plastic by 30%, and all the other things, running our factories at zero waste, is giving us 700 million euros of savings. I wouldn't like to be in the other position, where I have to pay the 700 million and have these devastating effects. Here we have the cake and eat it too. And there are many more areas that we can still continue to eat the cake. And it helps people thrive. Our Discovering Your Purpose workshop that we are now rolling out to all parts of the organization is showing enormous results in terms of even further building people's engagement or positive experience about their well-being of being in Unilever, more positive about our sustainability programs. And actually what we're now finding in the countries that have embraced this earlier, the business results are actually also better. The model is more relevant than ever, and we will keep driving it, but we need you to support this. It does make business sense, and it does create superior value for our shareholders. Let me just end simply by thanking the enormous support that I've had over the 10 years from our board. We have had an enormously supportive board. The board has changed over time, but the board is incredibly supportive of the strategy that we've put in place. And I have no doubts that they will continue to support this strategy that is firmly seen by them also as a very successful long-term shareholder creation. I also want to thank the board, and especially Marijn, for the way that they've handled the CEO transition. We started this about 12 months ago, and it was an incredibly thorough process. I've seen CEO transition processes in many companies. I also read the data out there of CEO succession. Certainly in this process, we dived into that, and it's a failure in many companies. We've seen some companies where CEOs are out after 6 months or 12 months again, or where the wrong CEOs are being picked. It's not an easy thing anymore in this environment. I would say that, not to be too biased, but this has been an incredibly positive and thorough process with an incredible outcome as well that you will only benefit from. I also like to thank you. We've not always looked eye to eye. We've not always agreed on all the things. I wouldn't like to have your profession, but I also echo Harold yesterday that he gladly acknowledged that you guys probably don't know how to do our profession either. So let's respect each other. Let's listen to each other. Let's challenge each other. But give the CEOs a little bit of space. Have a little bit of trust in what these CEOs want to do. Trust the CEOs by what they do and what they deliver, far more than you probably do right now. And don't put unnecessary pressure on them because it's the folk of the week or the folk of the months. Try to look at more things that aren't captured by the simple hard numbers. Look at what are the true drivers of long-term growth. Look at that also in your portfolios. Increasingly, I would argue that you don't have to compromise. The opposite. If you want to continue to provide decent returns for the people that you represent, start to also look at the decent companies that you want to have around in 10, 15, 20, or 30 years. Start to also look at companies that think about the world that the people you represent are going to be retiring in. That's the 290% shareholder return that we've given you. There's no reason why we cannot continue to give that support. There's no reason why we cannot give you that reward either. I thank you for all you have been doing. I thank you for the constructive challenges most of the time. And I also wish you luck in your own professional and personal journeys. Thank you very much. Thanks. We have some time for questions and answers, and I thought it would be a good idea to have Ellen and Graham come up here as well to join me, and that we spend the bulk of the time a little bit forward-looking would be the most constructive, and that's why they are here, because they're going to be the ones that are going to deliver. If you ask me for targets moving forward, that I will tell you. I'll probably double them. But if you ask how they're going to deliver it, they will tell you.
Thanks, Paul.
So who wants to kick it off?
It's hot here.
I know it's been a long 2 days. Go ahead. For the people listening in, just quickly identify yourselves and then.
Yeah,
Hi,
it's
it's
John Ennis from Goldman. Oh, sorry. You go. Okay. I just wondered if you could talk a bit more about the evolving competitive advantage of scale, because throughout the event, I think we focused a lot on data and distribution as being a key scale advantage for Unilever, and it sounds like you're insourcing certain jobs in media and IT. I wondered if in the future you could give us a steer on where you think the outsource versus insource mix will be for media, technology and marketing versus where we are today.
Yeah, so it's obviously guessing because we're working our way into this without really knowing where this ends up because there's so many changes happening in this world. But for example, in manufacturing or go-to-market, it's interesting that all the companies that we have bought, bar a few, you know, our Myanmar joint venture, our acquisition in Latin America, these were own factories that we've integrated in our own model. But the majority of the brands that we have bought, what we call these future growth areas, were actually using third party. They were asset-light models. And if we look at our own speed of change and our own categories, I would say that where we are currently, it's easy to see in the next, and Mark Engel should be here to give you the exact numbers, but it's easy to see that in the next 4 or 5 years, we would be about 30% outside on manufacturing and perhaps 60, 70% inside. There's a lot of reason, by the way, why we would be still inside and more efficient factories and other things. For many of our brands, as I said, that scale is still good for us. If you look at media, Keith Weed should be here. But I would say that the trend there is actually the opposite, a little bit. Because we are getting access to so much data and proximities to so many different channels and consumers, and the speed of acting in the personal relationships that are being developed with these consumers is going to increase, that you need to have less friction, less intermediates in that part of the organization. So, for example, our U studios, where we make our content. If you look at Ben and Jerry's, they basically, I think, correct me if I'm wrong, but they do everything in-house. And they would produce hundreds of pieces of content on a daily basis sometimes. So I see that part of the business actually coming back to our company. Doesn't mean they're only our people, but they should be seamlessly always on, 100% on the hip in the company. The time that you would work on 6 months of a big advertising campaign that you could then roll out globally and, leave on air for 9 years for 9 months is over, or 12 months. What you now have is a 3-second copy that you need to refresh every 5 minutes. Your websites that you have to keep active every few hours, and the thousands of consumers that you have to tailor your message to. A lot of that will be AI enabled, but a lot of that also will be real time done by people in our own organizations. That's what we're setting ourselves for up with the PDCs, the Unilever Clouds, the U Studios, and many of the other things we're doing. Would you agree with that?
Yeah, just a couple of things. Our acquisition business cases always generate enormous value from the synergies of bringing small and medium-sized businesses into our larger business, and that's a very quantitative measure of the value that we're creating through scale. And we're extremely good at delivering on the cost synergies in those business cases. Second thing, just to build on what Paul was saying, is we run, according to most benchmarks, quite a lean organization, but there are parts of Unilever where we can go a lot leaner. And you heard about some of that today, robotics, process automation. But there are places where we will add back headcount, particularly in the marketing area, as we choose to insource data management, content production, around things like the digital hubs that you saw. So there'll be a shift in the type of resource that's in and out of the organization, and still tons of places where we see scale advantage.
What was the question now?
Hi, David Hayes from SocGen. You mentioned, Paul, that the last few quarters we've kind of had evidence that the more aggressive models on cost have failed to create as much value as people were hoping. That perception shift that's happening, does that make it tempting for Unilever to basically use that to say, actually, we're going to be a little bit less aggressive on cost and margin. We're going to speed up some of that investment in digitalization, for example, that we just talked about earlier, and sort of the importance of doing that stuff quickly. Is that something that you think is, potentially on the agenda for the next couple of years? And then the second question was just on the culture of the business. As you leave it, do you think you're leaving it in the right place, or how would you want that culture to be slightly different from where it is now if you were to say it was at the optimum level? Thanks.
So if I may start with the last thing, I don't want to get into the self-congratulating mode, but I think it's a more competitive company now, and I think we're up there with the, we're in the A league of competitors. So I feel good about that, but that doesn't mean that it's where it should be. With this fast change, we need to still drive more discipline. I would always push to be even more of a consumer-centric company. And the area that I would put even more emphasis is intelligent risk-taking. This is still, by its size also, you have some inherent advantages, but you also have some inherent negatives that you need to compensate. But we would benefit from having a little bit of a higher risk profile, where we actually celebrate 5,000 failures that are very low cost, but then have 4 or 5 big wins that will more than pay for it. But in today's market, you need to continuously steer what you're doing with constant feedback loops that aren't failures anymore. They become learning loops that are very cheap and very fast to manage your model. I think we still have to learn a little bit more of that. One of the reasons that we did all these acquisitions and why we keep them like speedboats is that we now have a critical mass actually in the company, more or less, to learn from these entrepreneurs and these founders. And that's proving to be extremely useful. We have created the founder group. We've had dinners with them. We involved them in our business and benchmark with them. But they've also given us courage, to learn lean and mean and have these learnings quickly translated into action, to quickly react. The Michael Dubins of Dollar Shave Club, they reinvent their model every 6 weeks nearly, it seems. But they feel very comfortable with that. So we have a lot of work to do still there, and we would be better off moving further and faster in that direction. But I think broadly we have all these ingredients to do that. So that's the first thing. On the first part of your question, which just remind me for a second, I apologize. Yeah, sorry, I apologize. That's why I was trying to avoid the question, obviously not. I think it is fair to say that it is in our culture, it wasn't coming naturally or easily. Because we are a consensus culture, we are friends, we like to be nice to each other, and sometimes we mix that up with what is right for the business to all be around for the longer term. I think the warning shot that we got helped us to step it up a little bit at a moment that we perhaps were slacking it and go faster after these costs. So we turned that into an advantage. And I think it's with programs that we then embedded, like the 5S programs or the NRMs, they were very important parts of this transition to C4G. They weren't a coincidence, the core of the core and all the other things. So with the programs that we have now in place, the ZBBs and all that, I think we have embedded a certain way of working in the company that actually interestingly resulted in this year, for example. The year is not over, but obviously we can sort of project in this sense without giving you the projection of the year. But we are running ahead on the savings, which is a good sign. And we're actually running below the money that we thought we would be spending on restructuring, which is also a good sign, because it says also that the organization doesn't take the easy route out by buying their way out of a problem, but that they are running it with discipline and finding actually more savings in doing so. So it is getting into our way of working. It is getting into, and obviously Graham is playing an incredible role in that and the finance community, but it is increasingly being embedded into the organization. But it's an area you need to keep the pressure on. Because you will always be able to do more. But it's also important that you think strategically, if you're in Alan's position now, of what you do and when you do and how you do. Sequencing and timing is as important as anything else. So there might be more savings, but it's better to spread it out over 2 or 3 years and keep your growth engine going than going after it all at the same time. So it's a fine art. It's never exact. But I think personally there's enough in this company still to go by, not to worry about it. And that's why I was glad that Ellen was also reconfirming the longer-term margins that we've set for 2020. Obviously, you're not going to be blind and just be totally myopically focused on that. That would be wrong. It would be wrong if you all would force the company to do that. But in the current environment, what we know, and the business as it is right now, I don't think there's any doubt in our leadership team that that is a very reasonable thing to go for. I know we covered a lot in the last 2 days.
To go again, David.
Is okay?
Keep going in that case. So the third question, effectively. Obviously, to bring up the unification and the fact that didn't happen recently. But it's been mentioned, was mentioned yesterday by the chairman, that does close down certain options for the business, which I guess tends to lend it the thinking to be large acquisitions where you're using equity as well as cash. Is that right? Are there other options that are basically off the table that you think would need to be there? And then secondly, doing a big deal, is that the way that Unilever could still go? Or I think my sense was when we spoke about this back at Liverpool, I guess, that you said, big is bad now, if you like, and that agility is key, and it's not about just scaling for the sake of it. So I'm just trying to understand really why that is so important to the group and what options close down. Thanks.
So Marijn was right. It's for, and I think our shareholder base understands that unification gives us just optionality. It's better if you run a business not to draw conclusions about what you're going to do, but be sure that you have the maximum flexibility to be able to do what you might sometimes want to do. Why deprive yourself of flexibility? So the unification is a little bit complex. All the companies are going out of it, by the way. There used to be 30 companies that were duly listed. Now there are only 7 left or 6 left. So this last year alone, there were 2 others. So the reason for doing this, I think, is well understood, but it shouldn't be read into that means that there's a big acquisition coming. I think what we said at that time, that our strategy of doing what we actually have played out in doing and what I shared with you was not a bad strategy. I don't want to justify that because, as I mentioned, it's only the next 10 years that are going to give you the answer. Just buying them itself is not going to give you the answer. But I think what we're doing is a good strategy to consistently bring this company somewhere else. We see the markets changing so fast that buying a lot of these other things that we might have been interested in 10 years ago or so might not be the right thing anymore. We are more successful, we have grown, so that might be competitive and leakage issues, but also of relevance. If you see how a Dollar Shave Club has disrupted the shaving market, you would not have wanted to pay the price now for a market leader in shaving. I forget the name, but you know what I'm saying. So you have to be very careful in these big acquisitions. Having said that, there are certainly opportunities for us to make strategic acquisitions of size moving forward. It is not necessarily right only to assume that Unilever's strategy now, which by the way has to be decided by the next leadership and the board in charge, but it's not right to assume that Unilever's strategy is only to make small to medium-sized acquisitions. There are some possibilities of bigger acquisitions out there that I think would merit looking at if they ever would materialize. So you want to have that flexibility. So on the unification, I actually feel bad a little bit because I was trying to leave with no finished job. Many CEOs leave and all of a sudden you need to do a big restructuring, or because it's easy in the last year to make a lot of friends because you're leaving anyway and not do the tough decisions. So unfortunately, I'm not born that way, I'm not raised that way. And one of the things we thought was the unification is the right moment now, knowing that it was going to be very tough. And to do that with the long time period to study it, support of the board, looking at all these complexities. Most of our shareholders, obviously in the Netherlands, were for. In the UK also, the majority of our shareholders are for. But you have a minority of the minority that is able to express their wishes, which we would respect. And we cannot go forward. That doesn't mean that all these options are excluded. It means that we now need to live in a and understand the new environment that is being created, which is moving very fast, post-Brexit and all that, to look at all the other options that are available. It's not a matter of life or death for this company over the next few years, and therefore take your time to do it properly. Nor is it a matter of our shareholders defaulting, by the way, like some people and some papers like to talk about. I mean, they haven't found any shareholder that is defaulting. It would also be good if some of you speak up more, because you all are very supportive to us, so that we don't get this negative perception being created by some papers who want to sell more the next day. So I think we're all in this together to find a solution that is good. And interestingly, the ones that wanted us to stay in the UK was actually because they like what we're doing, and they like the returns that we are giving in an investment remit that they have that is understood but fairly narrow. So it was more of a compliment that they wanted you not to leave than that it was anything wrong with the way we're running our business. But here we are. And that's something that needs to be dealt with, but not to be put under pressure. I think you want to do it right.
Alan Erskine from Credit Suisse. Paul, a year ago in New York, I sensed that high degree of confidence in the organization that 2018 would see a step up in top-line growth, that you'd sort of embedded C4G, that the portfolio change was now starting to come into the mix. But looks like probably going to be towards the bottom end of the 3 to 5 range. Now, clearly, there were some macro headwinds that you probably weren't expecting in Argentina, et cetera. But was there anything else that has disappointed you this year in terms of the delivery on the top line?
Yeah, so obviously we take out things. I mean, it's always nice when Graham says, now it's this accounting, and then it's this accounting, and tomorrow it's that accounting. At the end, we have a pair of books, so what we report is sometimes not what the real business is. It doesn't include some of the new businesses and what we get out. And then you can say, today we don't do Argentina, and then it's Venezuela, then it's another country. So on an apples for apples basis, this year was probably more like the 3.5 or 3.7, 3.8%. But anyway, it ends up on the lower range of the 3 to 5, which we have maneuvered the market towards. I think I'm not disappointed in that, because we have a year where we have done a tremendous amount of portfolio work again, where we had a tremendous challenge to take the spreads business out, when people have done a heroic job to do that. We had to integrate some of our new businesses. We have had an incredible savings program in this company to be rolled out. We had to deal with an enormous volatility on the input cost and the effects of currencies. So yes, the year has had more factors to deal with than we probably anticipated at the beginning of the year. Because after 10 years telling you that it's going to be tough out there, and you were saying it's a pessimist, but it's always tougher. This year I was a little bit more optimistic, but it's still tough out there. And what you see on the global scene and the way that our politicians behave, unfortunately, is not really helping us still. I was hoping for better and hoping for them as well to rise to the challenge, but it's not happening. So what I'm disappointed about is perhaps within all of that, I would still say there's a 0.5% or 1% that's within our own control. But we've had such a busy agenda that the people should be applauded of what they have achieved in 2018. Has been a very good year for embedding a better cost structure, for embedding our C4G, for the M&A front that puts us well in the future. Has been a heavy agenda, and the organization has risen to the challenge. So no complaints in that respect. To your question, if it's next year going up or not, or more or not, obviously I know that the management team will be trying that. And we all like to be north of 4 in the normal circumstances. But it makes no sense promising that now and being heroic. First of all, I'm not going to be there to give it to you. And secondly, there are too many factors that have to be juggled in this incredibly volatile environment. Not least the enormous input cost pressures that we're seeing now again, or some competitive activities that we need to deal with, and some macro dynamics in these markets. So I wouldn't celebrate too quickly. In fact, after 2 or 3 periods of the IMF moving the global forecast up in terms of the global economy, they've started to move it down again. You've seen that. So we have to be, I think we have to be prudently careful, but I certainly trust the organization that we do the best we can. The priority is to keep this company growing. Don't worry about that. I think we now all understand in Unilever, all understand that BMI is not a balancing item anymore, or it's not just on achieving any margin at the expense of anything because we said something there. Consumer goods only works if you grow. You cannot save your way to prosperity. And if there's anything in the last 10 years, forget the USLP and forget more responsible business models and all that stuff, if there's anything on the hardcore side that we've put into this company, it's that. So wherever the year comes out, it hopefully will be an 11th year of top and bottom line growth and firmly cementing the new structure and changes, as well as these margins that we go after whilst maintaining the top line is a good result.
I think Alan.
Eileen Kuhn, Morgan Stanley.
Sorry, go on.
Yeah, there, I see you. Yeah, I see you.
2 questions from me. First of all, you mentioned, Paul, just now that you think pricing is less permissive than it used to be in the past. Can you give more color on how you see the balance of power there evolving in the future across your different channels? And then the second question, a bit of a philosophical one, but can you talk about the benefits of having food and refreshment in addition to HPC within Unilever as part of your portfolio generally? And then does the Horlicks acquisition signal an interest in entering sort of more nutrition type categories outside of the Indian market?
So in any businesses that you're in, always be flexible and never say never. You might, evolve in different environments. But what I've seen, to start with your last question, what I've seen is a convergence of trends. And often these trends are coming in food. We now have Hourglass, our very well-performing brand that Ellen bought in cosmetics. That brand is being driven by vegan and animal-free now. And what we are doing there and what the brand is doing is very much food trends being translated into personal care. Convergence of these trends of natural, organic, bio, vegan, if you stay there for a second, is actually happening. It's also that you see common areas that offer opportunities for developing new categories and new products that will become apparent to you and others in a few years' time that I think I was looking at. Not necessarily in the areas of what people have called nutraceuticals, but in other areas that are starting to emerge that we are thinking of. Besides the overall driver of proximity to the markets, I've always felt, we have a very good global business, but in Africa, for example, we use our food business to drive our home and beauty and personal care business. We would not have as strong a home, beauty and personal care business as we have today were it not for our food business. The cash that our food business has produced has served us very well to invest in the beauty and personal care, even though that Ellen is now giving a better return. That wasn't the case 5 or 10 years ago. So the fact that we have these businesses is not, to me, a problem. It actually offers a lot of opportunities if you think about it. But the real question you have to ask is not the playing of spreadsheets and PE multiples and how to get a little bit of this or that, because that's just silly games. What you have to look at is are we the best stewards of that business? And if we would not be the best stewards of that business, you have to look at other stewards. For example, in food, we are growing our food business at this scale faster than our competitors. In the emerging markets, we're growing faster. Our ice cream business is by far the best performing ice cream business in the world, and also contributing 1/3 of the cash flow to this company, with a strategy that wasn't apparent 10 years ago, where people were saying you have to sell ice cream. I said, that was the overwhelming consensus, get out of ice cream. I said, give us some time to see if we can make this business much better. There's no risk for you because you'll always get more for it if you wanted to get out of it. But it's turning out to be a very good business for us and creating very good value and shattering quite some norms, which is also making our overall business stronger in many of the other areas where we have that overlap. So that scale of ideas, scale of people, scale of subsidiaries, scale of creating new other categories needs to be carefully thought about. Much more than some other companies that just, and I've been in these companies, and I've seen these companies from the outside that just shuffle around their divisions under whatever banner and cut it in pieces. And you can continue to do that until nothing is left. Here it's a question of if we perform and if we can do it better, you should be very careful about that. And right now, my advice would be, for what it's worth, be very careful about that. There are many different roads that lead to Rome. Always think them through and look at opportunities and options that come along, but don't just rush into it because some people say that. Because right now it really helps this company be what it is and give you these excellent results. And there's no reason why that could not repeat itself over the next 10 years even, where I'm just sitting as an individual now, not as a CEO of this company. On your first question of pricing power, there's always a discussion on pricing power, there's always a question. In fact, in my 10 years as CEO of Unilever, I've always been challenged by one or another sitting on your side of the room about Unilever's ability to have pricing power. I don't think we have disappointed you there. In fact, there are whole new categories being created at totally different pricing levels than there were before that are doing extremely well in many of the categories. So the fact that you have e-commerce and price transparency, the fact that the conventional retail model is under pressure and puts pricing pressure on you because they need footfall and traffic, certainly are down forces. And we are aware of those down forces. The fact that some of our competitors are not performing as they would wish to perform is also a down force. We've seen some competitors prioritizing the US and China and putting a lot of money in there that we have to deal with. We see some of these cost cutters now discovering that they don't grow, so they put a lot of money now into growing. I mean, what's new? So we deal with that. That's probably the nature of consumer goods that I've been in for the last 40 years, and you need to anticipate some of these pressures. We anticipate that by increasingly differentiating our brands, by driving our innovations faster, by doing things like net revenue management to be a little bit smarter on how you do pricing. It's never going to be easy. This is not an easy business. But I think that I don't expect us to be in a situation of having to feel sorry for ourselves about our ability to price in this business. But it's a low price environment that we live in right now. This environment of higher inflation globally and the permissiveness to pass that on, also in these emerging markets, is more difficult. So you have to find other ways of doing it. And we are able to do that. You see our pricing go up a little bit again? But it's never going to be what it was in 2010 or 11 by memory. So that brings us also a little bit to the quality of growth. You have to look at the volume component. That's why I wanted this volume component out there. Remember, 10 years ago, we never talked about volume. We said we couldn't give you that. I don't know why we couldn't give that, but now we can. And it's the volume that is the quality, not the pricing necessarily. In fact, we take the pricing out for you with Argentina or Venezuela. We don't even want all of that. The real quality is really your gross margin expansion, which I know we've pulled this business towards a positive mix, which wasn't the case for the first 3-4 years. I said that was one of the most important things we had to do. It was called Max the Mix, and lo and behold, the company did it. But it did it on the strength of their innovation programs. And that's what we need to continue to drive. All of our innovations, 80% I would say, need to be margin accretive. I have to honestly say over the last 2 or 3 years, I haven't looked at it with that much of a commitment or determination, and perhaps Ellen can pick up on that again. But it is actually in our company because we are moving the gross margin up now consistently. But that's an important indicator, but it needs to come from our innovations. Pricing actually is a bad thing when consumers are suffering. Consumers are suffering globally now at a rate that they haven't suffered before. In the US alone, are 50 million people living out below the poverty line, 600,000 people living in the street, literally being homeless. That situation is a global situation. In France, the people are on the street, the yellow jackets, because they have not much money a month to spend anymore. It takes a little spark now to ignite. And we don't want to be that spark. So if we can help consumers provide better value so they don't have to price for it. So how do we build our margin? We build our margin by mix and innovation so that they don't have to pay for it. That's consumer goods at its best. We are 70% there, 80% there. We aspire to continue at least at that level or perhaps a little better. And then that's real growth. That's why you see a strong volume component in Unilever. It makes our factories more efficient, keeps our trucks full, and makes you reach more consumers. It's honest growth.
Thank you. Going back to food and refreshments quickly, I wondered if you could talk a bit more about the away from home or food service opportunity. I think Nitin mentioned in his presentation that he felt there was a synergy here from merging food with refreshments. But can you quantify what those subcategories are growing at today and how you can, what you're expecting growth-wise for them going forward?
Just on food and refreshments.
Just on the away from home and food service component of.
So I'm going to do a very unfair thing here. Alan hasn't run the food business; he has run the BPC business. But perhaps we can, if you feel comfortable.
Sure, of course.
To give you the answer.
Okay, thanks.
So the real question is, where do you see the opportunities on the out-of-home food business?
Exactly.
Yeah.
Let me be quite direct. The out-of-home food business over a long period of time and recently is growing about twice the rate of the rest of the food business. And that's without us properly tapping the synergies between in-home and out-of-home food. The best example is probably in China, where our food solutions business is multiples of the size of the retail business. And Nitin is doing a fantastic job of now starting to get much more leverage from the insights, the route to market, and the opportunities to play our brands across both channels. I hope that answers your question directly. It's a highly accretive part of the foods business,
It really is
and likely to remain that way.
It's a great business and a great channel, and I think the opportunity that's still to be tapped there is to move from back of house to front of house with our brands. So within our food solutions business, moving from, as Alan said, in China, it's a back of house, it's a kitchens business. How do you get from there to front of house, where you bring the brands together in that in that sort of distribution space? So still a big opportunity.
Take tea, for example. We are basically not we are the biggest tea producers, but we are really not present in out-of-home tea. We are a little bit, but we're not present. Now we have deliberately put a portfolio together of the Pukas, the Pure Leaves, the S2s, the Tazo. That Case did an outstanding job in getting some of these brands in the US. So we now have a differentiated portfolio to go into front of house and tea out of home. I'm convinced that more tea is drank of value out of home than in home. All of our tea business is in home. So theoretically, you could double your tea business over time if you really get the excellence in out of home. That's just the tea itself. And then all the other brands have tremendous opportunities. It's also, by the way, our most digitally connected business. In China now, we have 1 million chefs online that we train, coach, place orders and everything that this business has built up. So the digitization that you see happening in Unilever, we should have presented it, and perhaps that's an opportunity for next time. Food Solutions has actually set the standard. Every year, we have one award in this company, which is the highest, most prestigious award in the company, which is the Compass Award that we give to the business unit that embodies everything that we stand for in the Compass, the USLP and everything. And for the first time this year, India has had that award. Obviously, Bangladesh, Pakistan that you saw have had that award. So great businesses that you all know. But this year, it was Food Solutions that got that award, and well deserved.
So could it be sort of upper end of mid-single digit, lower end of high single digit growth for the out-of-home business? Is that sensible?
It's in that ballpark.
Okay, thanks.
We give you all these nice, rich answers, and all he wants a number, honestly.
Yeah, he has a blank still on his spreadsheet, 2 blanks still before the meetings are over.
Harold.
One is 3%, the other one is 6%. Just fill it in. It doesn't matter.
Following on from that question, Paul, what would be your advice to Alan towards setting targets and dealing with people like us?
I'll definitely have a discussion with Ellen in private about that. I'm just starting to think because I thought the answer I was going to give is pretty funny. So that's why I'm laughing. But I also decided not to give it. So I think it's very good. Thanks for the question. But seriously, I think you have to... I think the industry is changing. Your industry is changing as well. And just to be out there in numbers and listen to everybody is not the most useful thing of the time of a CEO either. But to find a few trusted confidants that honestly care about the company and that can give you a challenge is a good thing. To listen to everybody and to try to please everybody and to run this company by all wishes of the shareholders will lead to guaranteed bankruptcy. So you need to find the few that, like I have, the few that you trust, that you can talk to. And I won't call them out, but some are here, sitting here. And you need to really listen to them. And then you need to spend time with the investor base to really try to communicate what you're doing, but also understand, obviously, what people's concerns are. But some papers would try to suggest that we didn't spend enough time with our shareholders. You know better than I do that that is obviously an insult to our finance community, to ourselves. We spent hundreds of hours with our shareholders over the last 10 years and probably have had more of a reach out than anybody else. And that's why you've recognized us many years as the #1 company for investor relations and everything. So it's kind of silly that some of these people write about that now. But at the end of the day, you need to not try to please all your shareholders. The industry is changing. Things like ISS and all that are not fully working. There is these intangibles that need to be made tangible. You need to provide more transparency on the real value drivers. You need to explain what materiality is in what we are doing. You need to better communicate why the USLP is a value driver for the shareholders long term and all that. You cannot blame the shareholders or say they don't care. It's our responsibility to be sure that that communication is had and that that is better communicated. I've tried to do that. I've not always succeeded. But that is definitely what Alan has to continue to do, because you have people that come in and go. You have pressures that put you into different paths that are sometimes not helpful for our company. But likewise, you also have enormous suggestions that can sometimes challenge us. Not that we are complacent, but sometimes we're a little bit in the forest whilst you see the forest. And you see so many other companies. I also wish that you would come more, not you specifically, but that you as a group would come more with constructive ideas that you see somewhere else. You're in this incredible privileged position that you see a lot of companies. And you go over a lot of companies, you study them. We do, but we don't. You know, we do as well as we can, and we're in the industry. But, you know, I cannot sit in the boardroom or in 2 days with our other competitors. You can. So there might be also, if you really care about this company, which you do, and the investments that you've made in this company, which you have, then also share more areas that you feel we can be better, would be very welcomed by our team. I know it will.
Paul, if I may, I said yesterday morning that I was looking to listen and learn from this community. And I've had the gift of some very rich conversations over the last 36 hours. And the overwhelming theme that you have fed back to me is build a high-quality business with a clear strategy and a long-term future, and don't box yourself in with a spreadsheet and a set of numbers. That's the single-minded message that I've received, and couldn't be happier, quite frankly.
No, I'm glad you all told them what I told you, so I appreciate it. So then you know where your friends are. There is a sign here that says time's up, but if there's one more question, we'll take one question. If not, then no, don't want to force it. I just want to thank you for coming all the way here to India, spending 2 days with us. It is an honor. I run around the business here. We were doing some other things, Sanjeev and myself, but there's an enormous level of energy and pride. They get the great results, but they are enormously proud to have the global investors here at HUL. You cannot probably fully grasp the energy you're giving to this organization and what incremental commitment that unlocks. So I'm grateful for that. I want to thank you for that. And then once more, for your support, your trust, and most importantly, for giving that same support that you've given me to obviously Ellen and the new management team. I could not think of a better team to lead this business. I could not think of a better moment to step up the performance of this company in its broadest sense and to have a leadership change of this magnitude. Thanks for your friendship. I hope it will last well beyond my current position I'm in. And thanks for the support that you're giving to the new team. Thank you very much.